Joining us now, Morgan Stanley Wealth Management CIO Lisa Shalett and Invesco Global Market Strategist Brian Levitt. Good morning to you both. Lisa, I will start with you. As David mentioned earlier, perhaps this note from your colleague, Mike Wilson, adding to negative sentiment for the market today. Expectations around earnings recession, how deep that could go next year, what that means for how deep, I guess, further selling could go for equities as well.
Yeah, look, I think we've been, blowing this clarion horn for a while, talking about the reality of moving from living in a nominal world to back to living in a more real world. And what we mean by that is profits get reported in nominal dollars. And so over the last 2 years, company top line and bottom lines have been flattered. Not only by volumes that have benefited from the Fed and the fiscal government and fiscal spending from the government, volumes have been flattered, but they've gotten pricing, and they've gotten pricing of 7 to 9%, which is where top line inflation has been. As we move into 2023, we see that Fed policy probably is working. All of the indicators are suggesting that we are getting slowing, particularly on the manufactured goods side of our economy. So you're going to lose volumes at the same time you're losing pricing power, and it's going to be really, really hard to hold margins and to make some of these profit forecasts that are out there.
I want to get into that more, but first, Brian, do you see it the same way as we head towards 2023?
I think we have some near-term challenges, but not really. The market tends to bottom well ahead of the economy, and so this market was already down over 25% peak to trough. Now, in the near term, do we have to retrace a bit of that? Sure, but ultimately what the market is going to be looking to is a more normalized growth and inflation environment and a Fed that backs off the tightening stance. That typically sets the stage for the next recovery. Investors that wait for things to look good tend to miss that. It's all about whether conditions are going to get better or worse relative to expectation. The market's already priced in a decent amount of pain. Now, on the point about earnings, yes, earnings do go down in a recessionary environment, call it 15% or so, but multiples also tend to expand. And as interest rates melt amid lower nominal growth expectations, you could see multiples on stocks come back up. So, yeah, could you see a move down back to around the 3,600? Yes, because that would be an earnings recession, multiples creeping up some. But from there, we believe that the recovery commences as the Fed shifts to a more a pause or at some point a more accommodative policy.
Right. Lisa, kind of refreshing to hear a bit of a bull thesis out there. I'm just curious to your thoughts as to what you just heard.
I guess we just couldn't disagree more. And it really comes down to valuations, right? This market is either pricing, 1, 2, or a third scenario. Either we're pricing this idea that we get this soft landing and, the Fed immediately cuts, which we just don't think is particularly plausible, and we're suddenly off to the races. Or more realistically, we get earnings misses. That means that your actual, earnings, your denominator goes down. And while your price earnings multiple could go up, the reality is you're in the middle of a recession. And during a recession, consumption goes down, and forecasting the future is really, really hard. So I don't think, and I don't think history would suggest that markets start a new bull market really on the first uptick in unemployment.